Morning. Good morning, everyone. Thanks for joining me here in the Academy. I'm excited to be here. My name's Tim Katt, and I'm the Managing Director and Co-Founder of TACK Ventures. So before I jump in, I just would love to know who's in the room. Do we have any startups with us? Show of hands. Great. What about those of you from either leagues, clubs, team officials? Anybody? Great, cool, thank you. So for those of you who don't know me, like I said, I'm Tim Katt, the Managing Director and Co-Founder of TACK Ventures. TACK is an early-stage venture capital fund based in Brooklyn, New York, and we focus on anything that has an impact on culture. So naturally, that led us to sports when we founded the fund in 2015. So to take a look at some of our investments, they include Greenfly, which is a content management system that leading teams and leagues use to disseminate content to the people within their organization to increase engagement and build brands for their organizations. Shot Tracker is a company that's developed a chip technology that actually goes within a basketball and a sensor system within an arena that provides real-time autonomous stat collection that players and coaches can use on their bench during a game. And Overtime, also based in Brooklyn, is a next generation sports network, currently focused on basketball, but also has reach within soccer as well. So what qualifies me to talk to you about venture capital today? For the past 2 years, I led a group called the Global Sports Venture Studio in partnership with some of the leading organizations in sport. This program originally started as the LA Dodgers accelerator, which was the first sports tech accelerator of its kind. Over time, we saw the opportunity to partner with other organizations because of all the information we were collecting about startups, investment, and the entire ecosystem. So we worked with adidas, UEFA, Major League Soccer, NHL, to identify opportunities, develop what those opportunities could look like, and really operationalize them. Everything from investment to partnership. The one thing I found through my work with the Global Sports Venture Studio is there was really a need for education. How could we help these organizations understand this massive landscape of technology that was disrupting their businesses, but also providing a great opportunity for them to increase fan engagement and drive new revenue streams? So that's what I'm here to work you through today. So I'm going to take a really high level. Apologies for those of you who understand venture capital or are investors yourself, but I wanted to make sure we set the groundwork so we're all on the same page. So first, what is venture capital? Venture capital is private investment into companies with typically very highly illiquid or a long-term approach. So if you're an early stage investor, the first money that a startup's receiving, you have a 7 to 10 year outlay for when you can expect to see a return on that company. There's also a lot of uncertainty and risk, right? Whenever somebody's starting something new and you're putting capital into it, you never know where it's going to go. And the reality is most startups fail. So you have to be prepared with that mindset. But the reason you do it is because you believe there's high growth potential. And for everyone in this room, you're smart enough to know and to have seen how powerful venture capital has been to lead to IPOs of large companies like Facebook and Instagram and others. To dig a little bit deeper and to take a look at the different stages of venture capital, or I should say to contextualize venture capital, it's really seen as this early stage. Now, what's happened in the past few years as more and more capital has gone into investing in private companies, there's been a little bit blurring of the lines between what's private equity and what's venture capital. We'll talk about that more in a second. The goal is to eventually get to an exit, merger, acquisition, or IPO so that you can really realize the value of that investment that you've made. To dig a little bit deeper on venture capital, there's different rounds within that. Now, it might be a little intimidating if you're getting into the space for the first time, either as a startup or as a potential investor, and you say, oh, well, what are these different stages? How are they defined? The reality is there's no set terms that defines any given stage. And now it's even gotten more confusing. You have things like pre-seed, or people are taking it a step further and they're saying they're soil investments. But I've also invested in companies where it's their third seed round. So maybe like one breaking point is between seed and a Series A, where you expect a certain amount of revenue and a certain amount of traction. It's also very true that the global ecosystem is much different than how it is here in the US, and I'll talk about that in a little bit as well. So here's a look globally at venture capital, deal volume, and capital deployed. Sorry for the typo on the title here. But one thing you'll notice is that venture capital investment has been at an all-time high going into last year, even though deal volume was a little bit down. That being said, this year, indicators are that deal volume is actually up. But what that all means is that there's fewer deals being invested into, but since there's more capital being deployed, they're more expensive than ever. So it's really hard to be able to assess as an investor what value looks like, especially for these fast-growing companies. Another key part, which I think is really relevant to this room, is that corporate venture capital participation has really contributed a lot to this increase in investment. So going back to the recession, corporations have really rebounded along with our global economy, and as a result, they have extra cash on their balance sheet that they're willing to invest in new, more disruptive opportunities. So we've laid the groundwork. There's a lot more. We could talk for hours about venture capital, days, weeks. There's conferences dedicated to just that. But how is this relevant to sport? So I'm going to borrow a quote from another player in this ecosystem, Doug Higgins, who's founding partner and lead investor for Sapphire Sport. They're a $115 million fund out of the Silicon Valley. And what he says is sport, media, and entertainment markets exhibit the exact attributes you look for as a venture capitalist. Massive, rapidly growing markets being disrupted by technology. So Sapphire, before even Sapphire Sport existed, was born out of the company SAP. And what they felt like they had was the unfair advantage for investments that they could make to introduce them to the SAP ecosystem and serve that as a launch pad for the companies they were investing into. So very similarly, Sapphire Sport has brought together different groups like City Football Group, the Minnesota Vikings, which is an NFL team here in the US, their ownership group, adidas is participates in that fund. And so it's that idea of value add investing. So we're going to write you a check, but in addition to that, we're going to open doors for you that help add jet fuel to your company to help you succeed. Oh, there we go. So what's the through line about all these things? It's disruption, and it's really via technology. And so disruption is a scary word. It's scary to think about. We might have a little bit higher risk penchant here in the US to think about these things. And just to touch on that, you know, some of that risk penchant or threshold that we have here in the US ties all the way back to our country's founding, but even in the Bay Area, ties back to the gold rush and the mindset of going across the country in wagons and being displaced. I'm going really deep here, but and taking a risk to go do that and to find success. So that DNA of that part of our country has expanded into what eventually became Silicon Valley and the tech scene we see today. So the Silicon Valley, even compared to the rest of the US, has a much higher risk threshold, both as an entrepreneur taking a risk and as investors willing to take a risk on groundbreaking technologies that could have a breakthrough opportunity. Also here in the US, you know, New York and LA have since matured, and there's a new funds really focused on the rest of the country. And then when you look globally, I don't have a slide for this necessarily, but when you look globally and you think about seed investing, going back to the stages I was talking about, 22% of capital deployed here in the US is seed capital, whereas in Europe only 11% is seed capital. So there's not necessarily the same appetite to take on that risk. And there's also, from an entrepreneur perspective, when I work with companies in Europe, there's a lot more expectation around things you would expect from a business, like revenue traction and customers, whereas here in the US, we're going to continue to invest in those companies looking for a much longer play, a longer opportunity. So, sticking on the theme of disruption, the interesting thing here and the connection I'm making is that sports has actually benefited from the disruption of technology more than any other industry. And why is that, right? Well, it's created an increase in media rights value because sport has been the one thing that's kept customer attention or fan attention throughout all of the new technologies that have existed, and in a live setting. So as a result of that, we look and we have an increase in value of clubs or teams. And in some cases, that's led to new ownership. And a lot of this new ownership that's coming in and is able to write checks big enough for these new valuations of teams, they're coming from a different industry where they've had success. And sometimes that includes private equity and venture capital. And so when they arrive and they've just written a large check to be a part of these clubs and teams, they have a greater expectation for how can we maximize the value of that asset. And that's exactly what the Los Angeles Dodgers did when I was working directly with them. They created a fund called Elysian Park Ventures because they had just invested $2 billion into the Dodgers. First time team had ever sold for that much. And they wanted to say, how could we use this as a platform for new technologies and new things that's going to help our organization, but where we can also capture that value and realize a financial return. Am I one behind here? Yeah, sorry, I'm one click behind. Okay. So what's interesting is going back to this slide about what is venture capital, it's actually very similar to ownership in a lot of ways, right? We have private investment, often highly illiquid, not as high uncertainty as startup ecosystem, but there is certainly still risk, and not every team makes money. And the hope is that there's high growth potential and that these teams are going to continue to increase in value. The thing that excites me the most about sports technology specifically is that the innovation behind it is truly global. So whereas I was talking about how American markets are a little bit more mature as it relates to the startup ecosystem, when it relates to sport, everybody's a fan, right? We're all fans, and it ties us together. So there's a lot more interest in creating technologies for sport as a result. To capitalize on this, there's been a series of new funds that have stood up. And some of these are true venture funds where you have a managing team, right, your general partners, and then your LPs, your limited partners, and you have a set number of capital. For example, Sapphire Sport, which I was just talking about in their $115 million fund. Other groups, it's not quite as clear, but they have more of a callable capital structure where they're going to ownership or whoever their limited partner is on a deal-by-deal basis and saying, hey, we want to invest in this, and here's why we think it makes sense as it relates to our organization. This is by no means a comprehensive list, and also this number is really conservative. I mean, if you start to think about other things like some of the more private equity shops out there, like this is going to be a number that's in the billions and billions, not just 1 billion. But this is more focused on that early stage. And what are they looking at? Well, specific to sports technology, it's really broad. I think, I don't have it divided here on this slide, but the way we think about it is also how you structure your organizations is you have the performance side. How can we impact performance, create a better product on field? And then you have really the business side or fan engagement. So some of these categories can go across both of those, but we're seeing investment in both areas. To borrow another quote, this time from Gary Stevenson, who's President and Managing Director of MLS Business Ventures. This was a quote he had put through, I think it was in a Sport Techie or maybe even Bloomberg article about why he joined the group that I had helped start. It was to tap into emerging technologies and behaviors that resonate with our young and diverse fan base. So what's one thing that every fan has in common? It's, as it relates to their attention, it's that they use their phones, right? So we're not really competing against each other, leagues, teams. We're actually competing against the other things that people are experiencing from a content and engagement standpoint. So if we're not thinking about how are we going to get ahead of that, how can we invest in, and it doesn't even have to be invest from like a venture capital standpoint, but invest from like development standpoint, which I'll talk about here in a second. We need to do that just to stay even, much less break through. So this is an important point. You've heard these terms: accelerator, collective, incubator, innovation lab, venture studio. Those do not necessarily equal venture capital or investment. So this happens a lot. We conflate innovation and startup partnerships with venture capital. And so if an agreement is not capital in exchange for equity, then it is not venture capital. And that's really important, I think, for the startups to understand. But there's a key point here. That's okay. We don't have to invest. We don't have to take high risk shots, right? I mean, it's fun, it's exciting, it's great to think about we're going to invest in the next multi-billion-dollar company. But unless you have an expert, you're setting yourself up for failure. And even if you have an expert, there's no guarantee that you're going to be successful from a return standpoint. So where should you start, either as a startup or as an organization? So the first question you need to ask yourself, do you have capital or resources, so human talent, or even infrastructure, to invest in non-core business initiatives? And if the answer is no, then from a pure investment standpoint on venture capital, it's not for you, but that's okay. Number two, and by the way, when I say, do you have capital or resources, that could be a very small amount, or it could be, oh yeah, we're ready to really go attack and think about growth 7 to 10 years from now and what that looks like. But that's why it's important to be realistic about those resources and set a business priority for non-core investment. So with all of the different groups in sport that are focused on venture capital or doing those things like innovation labs, accelerators, there's really 3 motivating factors that I've identified that are all part of it, but really you should be prioritizing out of these 3 what it is you're trying to get out of it, and you need to be realistic, right? So if you're not putting a lot of capital to work, it's not going to be financial return, most likely. But innovation, I'll talk about what that means. And then marketing, that can't be understated as a very real thing as it relates to working with these emerging technologies. So number 1, financial return, which I'm defining here as true venture capital. What's the opportunity? And why are you as an organization maybe set up to succeed here? Well, number 1, which is true for any investor, it's about access. You're only as good as the deals that you see, the opportunities that you see to invest in. And so if you have a name brand team or club, something that hundreds of thousands or millions of people recognize, that gives you an unfair advantage to go out and to say, hey, we're here to invest, and you can be a part of what we're doing with our team. Number 2 is the opportunity to create pilot environments, right? And so I mentioned it earlier. I use this term jet fuel. How do we add jet fuel to these investments that we're making or create an unfair advantage? Now, you need to be very deliberate about this, creating this environment where you can set these companies up to succeed, but you also need to be realistic that any investment you're making is not make or break for that company, right? If you were not, as an organization or individual, involved at all, that company, you should believe that company is going to succeed, right? Otherwise, you shouldn't be investing in it. However, how can you set up your organization so that if you do invest and you do partner, that you can help that company get there faster? And then reach, obviously that goes with who your fans are, or everyone you touch, and how you can give exposure to the companies you're investing in through that reach. But the pitfalls, which are very real, are more than anything I see a lack of expertise. Those funds I showed, those have true storied investment professionals that understand venture capital dynamics, know how to do deals, know how to cultivate deal flow, know how to go through due diligence. So you must invest in the talent that's an expert. And they don't even necessarily need to know a lot about sport, right? They need to talk the language, but at the end of the day, you're embarking on that to make money, and you need to have an investment professional to get behind it. Number 2 is impatience. Like I said, this can be a 7 to 10 year, if not longer, outlay. So you've got to be committed for that long. You've got to have the highest people in your organization committed for that long. Too often I see a year or 2 in, hey, why isn't this working? Why isn't this exited? And it's just not realistic. And so then you tear it down, and all that investment in time and energy and capital goes away. And then lastly, I see a focus on sport. And what I mean by that is actually sport can be too narrow. So what I got excited about in the work I did with the Global Sports Venture Studio is that the organizations we worked with, they provided the scale. They provided the sport vertical. So we would actually go out and try to identify companies that had product market fit in something completely different, whether it was security or food and beverage, hospitality, something that wasn't immediately tied to sport. And we say, hey, we're going to open the door. Look, we can introduce sport as a whole new vertical for you. So that's important to think about. I'm going to run through it here pretty quickly because I'm running out low on time. But in terms of innovation and corporate development, this I think is the biggest opportunity for anyone with an organization in this room. So how can you create a performance advantage through what you're doing? And it doesn't mean you're going to go undefeated and you're going to win every single championship because you've invested or you're decided to work with one company. But it is table stakes that you're at least aware and knowledgeable about what's out there, and you make sure that you're preparing your guys with the best possible your guys or girls with the best possible performance advantage. Fan engagement, creating a better experience for your fans is always something we want to do. So how can new technologies help that? And then asset creation, right? I know a lot of you, you're in sponsorship and you want to think about how can we create new things that we can monetize. You can do that through development. The pitfalls here, again, lack of expertise, lack of buy-in, resource drag. You need to have somebody dedicated and focused on this who understands and knows how to set up that pilot environment and how to create success for both the companies you're working with and then you as an organization. Lastly is marketing and PR. So what's the PR opportunity? You can build brand development to be seen as an innovative organization. But I really encourage you to have alignment with the startups you're working with to make sure that they're on board with that too, because they can benefit from the PR as well. But do not leave them hanging as in, oh yeah, there's potential investment down the road here where we're going to write you a check for equity or we're going to invest in this. But you also have to understand that if you are doing a partnership with these startups, like they're bootstrapped, they need capital just to activate what you're doing. So you got to be willing to commit to that as well. And lastly, talent. So to be seen as an innovative organization that's working with breakthrough technologies, I think that can really help you draw talent into your front office, into your administration. Pitfalls, I mentioned collateral damage. I mean, this is more than anything is something that really bothered me was, or that I was really, I think, aware of and focused on is these people behind startups, like they're founders, and we create this kind of myth and lore around them, but like they're working every single day just like you, but they've got a lot more on the line. So just be considerate of that and treat them the way they should be treated. Resource drag, you know, if you have somebody who's not really prepared to be doing this and does not have the expertise, that's going to be a problem, and you're not going to get really true value out of it. And that ties into my last point. So, what's right for your organization? Hopefully this was helpful just to get the wheels turning, you know, and start thinking about it in those 3 buckets. And lastly, that's what I'm here for too as well. So please reach out to me. This is something I do. You know, in addition to investing, I also consult just in like a workshop environment to evaluate an organization and think about, okay, what are the steps you can take to start getting active as it relates to startups and new technologies. So thank you for your time. I hope you enjoy the rest of your time here at Soccerex and all have safe travel back home. Thank you.